Hello everyone, Sergey is here. First of all, I wanted to thank you for coming and to ask you to subscribe to my YouTube channel and to sign up for the online course. It's free. Everything is included into the description in that video. So today I wanted to discuss with you 10 steps to master the accounting theory. Those steps I kind of build them myself based on my learning experience and practical experience. And if you have anything to add, feel free to contact me or to add your comment under that video. I'm trying to answer all the comments. But let's move to the 10 steps. So the first step, I think, is to understand what accounting entity is and what is accounting transaction. And I did a little of a briefing here about that. So the transaction is some economic event which has monetary impact on the entity and entity financial statements. But what is an accounting entity? It is a separate abstract construct which is kind of presented separately from owners' own personal accounts and transactions and from the transactions of business employees and management. And that can be hard to grasp by someone. So far we can simply say that accounting entity is some company or some business which is independent from owners or management personal transactions. But you will have, if you struggle to understand that at this point, you will have a better understanding when you start doing accounting entries and understand the relationship of the business with that of its owner. The second step in the theory is to understand what accounting equation is and what is debit and credit and why they exist. Accounting equation, I have a bit of information here. You can Google the additional information if needed, or you can watch another videos on the topic or read the guidance. There is plenty information available on that topic. So accounting equation basically says that assets equal liabilities plus equity. So you have assets on one side of your balance sheet and you have liabilities and equity on the other side of your balance sheet. And another point of view is that is your business entity has assets and the other side of the balance sheet shows the sources of financing for those assets. And those sources can be liability like mortgages, bank loans, or it can be owners' own funds, which will show up in the equity section. You might wonder what the asset is and what liability is and what equity is. And the short definition for those terms is asset is something that you own, and it can provide you with future value or future economic benefits. Like if you own some real estate or equipment or inventory, it is on your balance sheet as your asset only because you can derive future economic benefits from it. And if it's just some useless piece of junk with no value, then it shouldn't be on your asset list. Liability is amount of what you owe to someone, and the liability shows you the future economic outflows from your entity. So for assets, future economic benefits inflow to your entity, and for liabilities, future economic benefits outflow from your entity. We will dig a bit further into that concept further in the course. So far, let's talk about equity, which is, if you change a bit accounting equation, you will see that equity is equal assets minus liabilities. And in your regular life, that concept is clearly demonstrated by the concept of home equity. when you want to figure out how much equity you have in your home, you usually take its market value or appraised value or whatever value your bank thinks that your home is worth, and you deduct the outstanding mortgage from that value, and you can say that, okay, that's the value of my mortgage. And so what about debits and credits? And that's where things get complicated, because you can Google up the definitions of debit and credit, but those definitions won't say much. They might say something that debit is something like increase in something and credit is decrease or something like that. But what you need to know is debits and credits exist, and usually in one entry debits are equal credits only because the accounting equation exists. And accounting equation exists only because we want to show on our balance sheet that assets are equal the sources of our assets. That's why if you are not into accounting long enough, it is best just to learn by heart how debits and credits are used. And I put a bit of a summary here. So debit is usually an increase in your asset, like cash. So cash increases by debit, accounts receivable, property, plant and equipment, and so on. And respectively, credit usually decreases an asset. And if you go to liability, you will see that debit decreases the liability and credit increases the liability. And equity acts more or less the same as liability, but we will investigate this further during the road of our lectures. On the third step, once you take a grasp of debits and credits, you need to practice the actual transactions. And on the third step, you go find any accounting exercises or transactions, and you make accounting entries with debits and credits. And that will be something like that. So you got like a transaction, someone invested $100,000 in his business, and you prepare an entry to that. So someone put $100,000 into the business, so business cash increases by 100,000, so that will be debit cash, and respectively, because that is the owner's funds, it should increase an equity by $100,000, and so on. Once you are good with doing someone else's entries, you can start to invent your own accounting transactions and post your own double entries. You can do that as a mental exercise when you have free time and you are not busy with your phone or something else. Then once you did quite a bit of transactions and you understand what accounts comprise assets accounts, what accounts comprise liabilities accounts, equity accounts, revenue accounts, expense accounts, you can learn the structure of financial statements, which is usually income statement, balance sheet, equity statement, statement of changes in equity, and cash flow statement. Once you do that, you can prepare some draft financial statements for your imaginary company or for actual company. If you already got an accounting job, you can try to do that yourself. And by financial statements, I mean only the first 4 schedules, not the notes to financial statements. That you will be able to do a bit later in your career. On the next steps 6 and 7, you will learn the practical aspect of accounting and how to do the research. And to do that, we will go to the IRS website and study one publication to see what IRS has put there and how we can understand it and apply it in practice. IRS publications usually impact your chart of accounts. You need to keep your chart of accounts organized in a way that it will make you easier to calculate tax liability and to pay taxes when tax time comes. So for example, if some expense is not deductible, it should be separated from the deductible expenses. Or if IRS has some different view on some expenses like vehicles, you can deduct that by miles or deduct that by actual expenses. Or depreciation, IRS can have its own depreciation, which is different from accounting depreciation. You need to keep all those expenses on a separate account, and that's why you need to kind of do some research on IRS publications. As for accounting publication and accounting standards, we will do that as well during the course, and that will basically help you to present some complex transactions appropriately in your financial statements and in your records. Then we kind of take a look of how we can prepare financial statements with notes. We will not do a full scope procedure here because it alone can take more time to do the foundations course, but we kind of learn the basics. Then the person can start to acquire practical technical skills of using accounting tools like accounting software like QuickBooks and spreadsheets. In the course we will do that along the road of doing everything else. And on the last step, when someone usually gets a job, he will continue his learning all his career, because accounting standards and guidance and IRS regulations are always changing, and you need to keep yourself updated on that. That can be a bad thing because it takes time, and that can be a good thing because if you do that, your value as an employee increase tremendously, or as an independent accountant, and that provides quite a good job protection. So that's our 10 steps. If you disagree or if you have anything to add to that, feel free to comment on YouTube, subscribe to my channel, sign up for free course. You can do that even after the beginning of the course. All previous lectures will be available via YouTube. Thank you and have a great day. Bye bye.